Just because your asset allocation gets more conservative when you retire doesn't mean that should be static for the remainder of your retirement.
Welcome to Blind Spots, a podcast where we're helping you fill the gap between what you want to do with your money and what you actually do. We are professional investors, writers, and financial planners helping you navigate the complexities of finance to optimize what you can control and cut out the rest. Join your host, Nik Schuurmans and Erin Varghese, as we discuss the questions and nuances surrounding everyday money management. Investment advisory services offered through Pure Portfolios, a registered investment advisor with the U.S. Securities and Exchange Commission. Nik Schuurmans and Erin Varghese work for Pure Portfolios. Any opinions expressed by Nik and Erin or any podcast guest are solely their own opinions and do not reflect the opinions of Pure Portfolios. This podcast is for informational purposes only and should not be relied upon for investment decisions. It should not be construed as legal or tax advice and is not intended to replace the advice of a qualified attorney or tax professional. Clients of Pure Portfolios may maintain positions in securities discussed in this podcast. This information is not an offer or solicitation to buy or sell securities. The information contained may have been compiled from third-party sources and is believed to be reliable. Hello, everyone. Welcome back to the Blind Spot podcast. Today, we are going to be talking about, in our opinion, the biggest risk to retirees.
Yeah, so if you're qualifying that title, it should say the biggest risk to retirees that you can't control. So actually, the biggest risk to retirees, if we were just to leave it there, would be a retiree spending way too much. Like what retirees spend, in my opinion, after having run 1,000 financial plans, the biggest input into the plan that would determine success or failure is what the retiree is spending on a monthly or annual basis. This is going to be about the biggest risk to retirees that you cannot control. So you can control what you spend. You can't control what the stock market does, and most people know that. This is a little more nuanced. We're going to take it one step further. The biggest risk that retirees cannot control is called the sequence of return risk.
What is the sequence of return risk?
In its most simple form, it is experiencing a negative market outcome in your early years of retirement. So think 2007, you worked for 30 plus years, you recently retire, you're invested the way you think you should be. The market takes a 40% dive. Now, I don't care if you're a 40% equity investor or 100% equity investor, we all felt pain there. That would have been a disastrous outcome for a newly retired person.
What kind of effects would that have on someone short-term and long-term?
So looking at the most extreme example, you would have lost money in the stock market, right? So your portfolio is smaller. And then think about a new retiree. Maybe you retired at 60. Humans are living longer than ever these days. Your life expectancy is 35 years. Your portfolio just took a haircut at the exact point in time where your money needs to last the longest period of time. Throw in the fact that most retirees take some sort of distribution or income off of their portfolio, and you're getting hit multiple ways. Your money needs to last for the longest period of time. You're taking money out of your portfolio, which is suddenly a lower amount. Now, the risk there is we all understand negative outcomes are part of investing, and that's certainly true. But the extreme that we're looking to avoid is if your capital base, if your portfolio is impaired in such a way where it can no longer support your lifestyle for 30 plus years, meaning you turned a favorable retirement plan into a challenged plan by getting hit with those three things that I just mentioned, and your capital base is impaired. Okay, first I want to back up because I don't want to make it sound like someone who experiences a market loss in retirement is doing things wrong. Back to my earlier comment, negative outcomes in investing are just part of the territory. They're the cost of admission. What makes this loss special is that it happens at the start of retirement. So let's play this at the opposite end. Let's say I'm 90. I'm expected to live another couple years. And my portfolio loses 25%. But I have more than enough. Like that's not a catastrophic outcome because I have more than enough for the rest of my life. Maybe my future generation, my kids and and my grandkids get less. So what we're talking about is negative outcomes at the start of retirement.
So let's say someone retires. They experience this negative outcome in the early years of their retirement. Not thinking about this from a financial or numbers standpoint, How do you see this negatively affecting someone psychologically or emotionally as they continue throughout retirement?
I think that's the biggest wild card. And this is going to be different for everybody, but
Sure.
psychology and money, emotion and money is real. And if you were, again, I'm going to go back to 2007 and 2008. If you were a newly retired person and you thought you were a balanced investor or a moderate risk investor and your portfolio lost 25%, that probably wouldn't feel good. You would be gun shy going forward. And the way that could manifest itself would be hunkering down, going to all cash, selling your equities at a loss, and just hunkering down for the fear of losing more. Human psychology has told us that humans hate losses much, much more than they enjoy gains. So to answer your question, the risk there would be derailing your well thought out investment plan just because the recency bias of losing 25%, let's say, is still fresh in your mind.
Sure. So there's a lot of things in life that, of course, you can't control, markets being one of them. What can someone do to mitigate the sequence of return risk?
The biggest thing, and this is perhaps an obvious answer, but through every crisis, I've been doing this a long time. I've been doing this for almost 20 years. And whether you're talking about 2008, the fourth quarter of 2018, spring of 2020, the clients with the best investment outcomes are the ones who are honest about their risk capacity before something happens. So that means we're able to quantify your acceptable range of investment outcomes during a non-crisis time, right? So you might say, hey, Nick, if I lost 10% over a 6-month period, it wouldn't feel good. It wouldn't make me happy, but I'm willing to incur that loss for the potential gain of X. Where catastrophic mistakes get made is when someone in a non-crisis time is telling us that they're a risk-seeking investor, meaning they can handle the swings of a 70% equity portfolio. They're telling us that, but then the stuff hits the fan, the market goes down by 20%, and they're saying, whoa, I need to sell. I'm not comfortable with this. Well, looking backwards, their true risk tolerance was not 70-30. They were embracing risk during a period of normal stock market returns. So the market was going up. Now they're shunning risk when the market is going down. That's not investing. That is an emotional disaster. And that person was not honest about their capacity to take on risk before something happened.
So I want to stop you there and go back to something that you said earlier about your time frame for your risk tolerance, because you said 6 months. So why would you quantify that in 6 months rather than 12 months or 5 years or 10 years?
That's a great question. And as investors, as advisors, we've been conditioned to think about financial market returns over a long period of time. And I think that makes sense for someone that's 25 or 35 or 45. For folks that are retired, it's really hard to stick to a long-term investment plan if you don't fully understand the range of outcomes within a shorter period of time. So that's why we use 6 months. So we show all of our retired clients, about to retire prospects or clients, what their range of investment outcomes could be in a 6-month period. And if they're uncomfortable with the downside, then we go back to the drawing board and we tighten up the allocation, probably reducing equities and adding to fixed income or gold or a combination thereof, to make sure that they're comfortable and they fully understand the range of outcomes in the short term, in this case, 6 months. So, again, I think the risk tolerance equation is broken because you're basically asking people how they feel about risk, which I like to say risk is when the stuff hits the fan. You're asking people how they feel about risk during a non-crisis time. Investing money, that's all emotional, and it's impossible to recreate the fear that exists when your nest egg, your retirement nest egg, is going down in value and you can't do anything about it, okay? So I always like to go back and ask people, how did you respond in 2008? What did you do in the fourth quarter of 2018? What did you do during the COVID sell-off? Because that's a live simulation of fear mixed with money. And if they give you an answer like, oh, well, I sold everything. Oh, I sold all my stocks and I shifted to bonds. It's time to go back to the drawing board and revisit and be honest about your true capacity to take on risk.
So being honest about your capacity for risk is one way to
mitigate your sequence of returns early in retirement? What else can someone do?
So if you're retired and the market starts to take a dump and you're taking $5,000 a month, it would be prudent, one, to look at your expenses to see where you could cut back. And two, it would be prudent to reduce the amount that you're taking out of your portfolio. Because again, the biggest risk is portfolio goes down, you're taking the same amount out, and your capital base is impaired. Your portfolio is impaired and can't support you over 20 or 30 years. So tighten up your expense side, take less out of your portfolio. It's also a good idea to keep an emergency fund. So, if your monthly spend is $5,000 a month, maybe keeping a year's worth of expenses. I know that's not necessarily attractive for folks just because you can't get anything in a CD or a safe type of account. But it is nice to have a cushion so you don't have to sell anything or put stress on your portfolio during a adverse market environment.
So with emergency funds, do you think that a year's worth is kind of the hard and fast rule? I tend to tell clients 3 to 6 months, depending on their financial situation, dual income, steady job, etc.
Yeah, and I think most people, by the time they're retired, have some sort of an idea about what makes them feel comfortable, right? I have clients that always want $500,000 in their bank account, and they've been that way for a decade. I have clients that they want to squeeze every ounce of return out of their investable assets. So they'll send us cash if their cash balance in their bank account gets above 20,000. Mm-hmm. So most of us develop these weird mental shortcuts, if you will, as we get older. But, I'd say anywhere from 3 to 6 months, on the extreme end, maybe a year. But again, if you're working, it depends on the riskiness of your employment income. Depends if your spouse is working, but I don't think you can go wrong with those numbers, 3, 6, or a year.
So you just mentioned mental shortcut. Let's talk about target date funds. What are they? Why are they helpful? Why are they important?
I don't know if they're helpful or important, but I know they're the ultimate mental shortcut for folks that don't want to build their own investment portfolio. And 401ks have come a long way. The rules have changed. And before, what used to happen is if an employee didn't designate the type of portfolio that they wanted, like if you didn't actually build your own portfolio within the 401k fund menu of your employer, then that money just went into cash. And what ended up happening is many employees are checked out. They're focused on their families, their jobs, and they're not really in tune with their retirement plans. So that money would sit in cash. And of course, that's not a viable long-term investment strategy. So the government said, hey, let's make this simpler for folks. If someone doesn't designate what fund to invest in, let's go ahead and allocate it to a target date fund, or let's go ahead and sweep it into this allocation. Target date funds are the ultimate mental shortcut if you don't want to build out your own portfolio. So it basically states the closer you are to retirement. So if I'm going to retire in 2025, that's going to be a relatively conservative portfolio because I have less time to make up any losses. And if I'm going to retire in 40 years, let's say, that's going to be probably 100% equities because I have multiple years and decades to not only make more money, but recoup losses and let the power of compounding in financial markets work in my favor.
So if someone is not as familiar with a target date fund, you said that the closer you get to retirement, the more conservative it's going to be. How conservative do you typically see target date funds getting when you're, say, 3-5 years out from retirement?
So not as conservative as you would think. And a lot of these target date funds have gotten into hot water. So back in 2008, many folks that were invested in target date funds that were close to retirement found out that they had much more equity exposure than they set out to. And these target date funds are not exactly transparent. Like if you're just looking at your statement, you see target date fund 2025, that says nothing to you about the overall asset allocation, the mix of stocks to bonds. So back to 2008, what people found out was if they were retiring in 2009, many of these target date funds had like 50% equity exposure. That is probably higher than most people would guess. So sure. What happened is these funds cratered. A lot of the fund companies got sued because retirees said, hey, this was supposed to be a conservative investment and I'm down 30% and now I'm retiring, or now I can't retire.
That would be some hot water to be in if you were those fund companies. So
yes.
Gentle reminder to check your 401k statements, old ones especially, see if you are invested, how you're invested, and then if you're in a target date fund, what does that actually look like for you in your stage of life?
Yeah, what's the mix of stocks to bonds in that target date fund? Because it's different from Fidelity to Vanguard to BlackRock. I mean, there's no uniform mix.
Is there anything else that you wanted to say on mental shortcuts?
Yeah, so target date funds glide to a more conservative asset allocation the closer that you get to retirement. And most people know that. So most people understand if I'm 30 years from retirement and 29 years later, they understand that natural arc of reducing stocks and increasing their allocation to bonds. So in other words, that portfolio is slowly getting more conservative the closer that I get to retirement. Most people don't understand the reason why. The reason why is sequence of return risk. Large fund companies, empirical evidence would suggest that sequence of return risk is the biggest risk to new retirees. That is why that portfolio gets more conservative as you get closer to retirement. So you might think, or it could be a misconception to think that as you get closer to retirement, your portfolio gets more conservative and it should also stay more conservative. Okay. So we all can agree that to mitigate sequence of return risk, it's important to be honest about your risk capacity, perhaps get more conservative in your investment portfolio. Okay. But let's say you're 5 years into retirement. Let's say you're 10 years into retirement. Does your current plan, life expectancy, portfolio justify that more conservative asset allocation? I would argue no. And I used an extreme example at the top of our show saying if I'm 90, I only have a couple of years to live, I could very well make a case for 100% equities. Now, I might have been a 50% equity investor at the start of my retirement, but 30 years in, I might be a 100% equity investor because one, I have enough to supplement my lifestyle. Two, I'm going to be dead in a year or two. That money is going to my kids and my grandkids, which have a longer run rate. So the message is just because your asset allocation gets more conservative when you retire doesn't mean that should be static for the remainder of your retirement. And I think this is super important because bond yields, cash yields are at all-time lows. It's really hard to generate the return out of safe asset classes, especially over periods of decades, and especially when the cost of living keeps going up. So make sure that you're always revisiting your investment portfolio within the context of your financial plan, because the circumstances do change over time.
Yeah, I think that in addition to looking at your asset allocation later into retirement, it's also worth noting that sequence of return risk isn't only for retirees. And maybe this is more of a point on just general asset allocation, but let's say you're younger, maybe in your 30s, you receive an inheritance and you decide that you're going to retire at 40 or 50. That might be another time or another event where you should look at that and determine what your asset allocation should be. Because just because you're younger doesn't mean that you necessarily have a longer time horizon depending on your goals. It's like a very specific example, but different things come up.
Yeah, so it's not uncommon. Like I have a few clients that as they retired, they were 50% equity, 50% bond, but later in life, they've shifted to 100% equities not because their risk tolerance has changed, just because their life expectancy is shorter. And that portfolio is earmarked not for them, but maybe a charitable gift, a philanthropic endeavor, a future scholarship fund, or their heirs. So always make sure that your portfolio and your financial plan are consistent, and understand that the period 3 years before retirement, the period, let's say 1 to 5 years into retirement, that's your retirement danger zone. And for every pure client, we throw random negative return years as soon as they retire, because we want to understand if we stress their plan with sequence of return risk and run it out over 30, 40 years, are they going to be successful? And I think that's extremely important to understand.
What would be an example of common mistakes that you tend to see investors have as they approach retirement age that might impede them from potentially having successful retirement, or that might put them at risk for sequence of returns?
I'm going to go back to my earlier comment. Like the biggest mistake people make time and again, and I don't care if you're about to retire or you're not retired, the stakes are much higher if you're about to retire, but just not being honest with your capacity to take on risk. That's the biggest mistake. And, I'm going to be writing about this either next week or the week after, but someone asked me, what's the, similar question, what's the biggest mistake people make that you see time and again? And there's all these different mistakes that people make, but it all stems from one large issue, one systemic issue, and that is trying to avoid losses. Most every mistake an investor would make is traced back to trying to avoid losses. And my message is the sooner people can embrace and accept the fact that negative outcomes are part of investing, the better off that they'll be. Just because your portfolio is down doesn't mean it's broken. Just because you lost money in a calendar year doesn't mean that the markets are rigged, or, the Fed is off their rocker, or the system is broken. Negative outcomes for the last 100 years, for the next 100 years, are part of investing. Look at it as the cost of admission, the cost of doing business. Because think about it. If you could set your watch, if everyone in the world could set their watch to getting 10% a year in the stock market, everybody would do it. There would be no bonds. There would be no cash. There would be no cryptocurrency. There would be no gold. Everybody would shovel money into the equity market. That's not the way it works. You shovel money in and you can capture that 10 to 12% or whatever a year because you're taking risks. The probability of loss is there. It's going to happen. So that's kind of a one-off rant, but I see it time and again. And, and you get the folks that say, well, I want something that goes up in value, but doesn't lose money. And then they laugh. It's like, they're laughing, but that's how they actually think. People think that they're special, that they deserve, the outsized market returns without any of the risk. That does not exist.
So when you are having a conversation with someone who does say things like, I only want something that only ever gains and never loses, what does that conversation look like? How do you kind of talk them off the ledge?
I'm an evidence-based investor. So what that means is I'm going to try to educate that person. There are certain cognitive issues that you can fix with education. So I'm a big fan of market data. Of course, the past doesn't predict the future, but markets do move in cycles. And, markets are comprised of humans trading with other humans. Humans are predictable beings that follow patterns. They might be erratic in certain instances, but history tends to repeat itself. So long story short, I would try to educate them, but there's certain emotional biases that you just can't educate. And you can talk to them about big picture and like a high level detail conversation, but money in investing is extremely emotional. And if they're on the extreme end, I would just say, I can't work with you, because if our expectations are misaligned, or they don't understand, or they don't accept that negative outcomes are part of investing, it's just not going to end well.
So set expectations, understand your asset allocation and the ramifications that could potentially have, allocate your investments appropriately, and
understand negative outcomes are part of investing.
And reevaluate from time to time to see if that particular allocation still fits in with your current financial picture.
Yeah, and then just one other comment on the sequence of return risk. So you don't have to guess with this stuff. I mean, like I said, our financial planning software captures the date that you're going to retire and then throws in random back-to-back negative return years. It does that on purpose to simulate the worst case scenario, which would be back-to-back negative return years. And then we run the plan as is over 10, 20, or 30 years with the impaired capital base at the start of your retirement. And if your plan is successful after that, that's a very empowering place to be.
Yeah. I think it's also great for clients to see the impact that those negative returns have as well, having that lower base to go off of for the next, say, 20, 30 years, and see the impact that really makes on their total portfolio.
Yeah. And so you can actually take it a step further. You can not only stress the plan for back-to-back poor return years when someone retires, you could also increase expenses. You can show them buying a second home or having a healthcare event. So it's nice to be able to stress the plan from multiple angles. And if it's still favorable, that should give the client peace of mind, which is all we're trying to do.
Well, good. I think that probably about wraps it up for today. Any last comments you want to make?
No. So next time, and perhaps I'll have the blog published by then, but I'm going to be writing about how most investor mistakes can be traced back to trying to avoid losses, and it never ends well. And there's case study after case study I can show, but I'm just amazed at some of these people that, I think you were saying a friend of yours was proclaiming the stock market is going to crash in 5 years. And it's like, where do people get this stuff?
Right.
And it manifests itself by them selling everything and hunkering down and sitting on cash or waiting for the market to crash. And it's like all of these stupid things that people talk about and predict manifest itself with tangible mistakes where this is costing you money, but they don't see it that way.
Right. All right. Thanks everyone for listening to this week's episode of Blind Spots. You can catch us on our YouTube channel where we have financial planning videos, portfolio management explainer videos, as well as this podcast. Maybe you're listening to it here. You can also check out our weekly blog that Nik writes. pureportfolios.com/blog. If you have any ideas or topics you'd want us to write about or podcast about, let us know in the comments, let us know on social media or via email. Yep, you can send those over to insight@pureportfolios.com. We'll see you next time.